guys all know Bruce. Bruce Norris.
Thank you. How's everybody? Interesting world of real estate we have here. All right. What I'm going to show you, a chart that I created called a Moodometer. So a Moodometer is a calculation that says, in any given year, what percentage of your median income did you have to pay if you bought the median price house in California with a 20% down? Okay? So that's a percentage for a long period of time. So the gold represents the peak, which we've hit only a few times. Okay? So that really calculates capacity. So why don't we always buy real estate at full capacity of our budget? Because we're not in the mood to do it. So this is why I created this chart, because mood is more important than any other statistic, because it's a very odd thing about human beings. So in 2021, how many of you sold anything? Multiple offers? Craziest price you ever thought? You went, what? Okay. Well, isn't it interesting when prices are extremely pushing that maximum that you have so many people interested in it? So take a look at the Moodometer, say in 2008, 9, 10. It's below 30%. What did we have to do in America to get somebody to buy a house that was already on sale by 60% off? We had to give them $8,000 bonus to buy one. Isn't that interesting? So this is the greatest cheat sheet in real estate for me. I don't have to be affected by the mood of the world. I can look at this chart and go, if it's below 35%, it's on sale. If it's approaching 60%, maybe you can have my stuff. It's just that simple. So we made this calculation, and we made it to where we could play with it. Now, I want you to look at this chart and say, look at 40%. So 40% as a mood of a buyer. In the last 16 years, we've only been over 40% 4 or 5 times. So the normal isn't 60, it's not 50, it's not 45. And I want to show you why that matters as we take a look at this. So how many of you think the mood toward real estate has changed? Yes. Okay, got anything for sale right now? Yes. Everybody flocking with multiple offers? Okay, so the mood's changed. Well, that means the percentage has changed. So think about that. We're not at 60% mood. Our capacity was 60%, but now our mood goes, nah, I don't want to do that. So now we'll take a look at the math of that. So what happens to the math of the median price California if your mood goes from I'm still a bit happy, or it's normal, or I'm not happy? Can you guys see that? Okay. So this is a 45% mood. So it's above average mood, and if you have an interest rate of 7, you can go all the way to the left, and it says that your median price should be $520,000. If your interest rate goes up to 8, at that mood, go all the way to the left, it goes down to $475,000. That's an above average mood with 7% interest rate. We are only $300,000 higher than we should be. Isn't that scary? That's scary. What if the mood goes to 40%? So now you're in that range where, again, we've only had 4 or 5 years over this for the last 16. Your median price, if it's just a math function, is $465,000 at 7%. So this is pretty terrifying. If you're in a really bad mood, you get to 35%, then it's already supposed to be at $410,000. And if interest rates go up to 9, it's $335,000. Aren't you glad you came today? All right, so what the math formula probably isn't going to occur, and that's what we're going to talk about now, is what probably will prevent it. So this is the percentage of interest rate, or percentage of loans in a certain interest rate category. So we've got tons and tons of people with great loans in place. So if you have a 3% mortgage or 2% mortgage or 4% mortgage and the current rate is 7, is there a good chance you go, yeah, I'm good? What happened in the last 2 years is people thought, you know what, we've always wanted an office in our home or a 4th bedroom or whatever, and they did that, and that's in place. So there's a good chance that a lot of homes don't show up for sale. It's possible you could have a 50% decline in sales. That's very likely. And it might be matched with just that many buyers to where you have an equivalent group of sellers and buyers. And the group of people that have these great interest rates don't participate. It just doesn't show up. What's really cool about this interest rate being in place, let's say you have a big price hit for some reason, there's a good chance that house will cash flow as rental. So it's a one time in history you could have a negative equity position and have a positive cash flow rental. So do you lose the house? Nah. You just say, okay, keep it. Let's say you're one of the people who lose their jobs. That's the category that could cause urgent sales, okay? So if you lose your job, well, I'll keep it as a rental. Instead of losing my credit and lose my house, that's the first time in history that's actually been around, okay? This is a chart of adjustable loans recently. So very few adjustable loans. We don't have any explosions waiting to happen where people are going to have their payment crank up. So that's been a very safe decade of that. We have record equity positions. So we could have a price hit and still have huge amounts of equity, which is a great thing. And we sort of were disciplined this time. Up until the very end, we didn't pull out as many billions of dollars as we did the time before. So we've got good equity position. We have room maybe on our credit lines, or we have room if we have to sell. We have equity to where you don't become an REO. It's going to be very interesting. This is a national building chart. We'll also look at the California building chart. But the national building chart, you can see in the 2005-06, we overbuilt like crazy. But then we just couldn't build because for years, the existing inventory that was REO was below replacement cost. For a builder, there's no way. How could you compete in Florida where you could buy a 2-year-old home for 80 grand? You can't build anything. So that reflects that. And then we started to catch up. So you don't have a gigantic overhang of building nationally. You have existing homes available way below normal. So under 1 million existing homes available for sale. And normal is floating around twice that. So you don't have a ton of sale going on with the builders or the people that own the property. So this is U.S. jobs. So you have a huge amount of job openings. And you have about twice as many people looking for jobs as you have job openings. So that's a ratio that doesn't usually happen. So that supports employment, and it also supports wages. So that's good. Unemployment, way back down there, 50-year low again. So, I'm trying to think, okay, how do we end up with this gigantic, urgent pile of inventory? Because what the charts that I didn't get to show you was what really damages price. So in the 80s, we hit one of those peaks of Moodometer, 60%. And we had interest rates that were 16%. And we had unemployment that was 10%. And we had how many months of inventory? 22 months of inventory. No price damage. I mean, you gave me those 4 charts without me knowing the result. I'd go, oh, wow, devastating. No price damage. How's that possible? Well, REOs were 1 in 4 of the percentage, 25%. In the 90s, it got to almost 40%, 4 out of 10 at its peak. And we had about a 10% price damage over a 5 or 6 year period. But in 2008 and 9, we had a 50% price hit. Remember back in 80, we had 22 months of inventory? In 2008, we had 8. In 1980, we had a 16% interest rate. And in 2008, we had like a 5 or 6. So that's when you're trying to figure out, okay, well, what causes this stuff? Well, REOs represented 7 of 10 sales. It was the market. It was the comp. If you were an appraiser, you couldn't ignore that. It was the market. And so when you were fixing houses, I can tell you this is what happened to us as flippers, is that you'd buy a house that was 2 years ago $365, you'd buy it for $65. put 20 grand in it, put it up for sale for 125 grand, have 25 offers the next day to buy it because it was the only great fixed-up house, and then the appraisal come in at 95 because every other comp was 75, and they couldn't. There was such pressure that the appraiser, if he had come at 125, which was literally the right number because the market said that, there would have been a review appraiser that came over the top and said, no, 95. And that guy that said 125 would never have gotten another appraisal assignment. So that's how important not having a huge amount of urgent sellers in the market, including banks, okay? This is California construction of new homes. So builders are usually the worst timing experts ever because they go by the mood of the market. So at the very peak of the mood, if you have a debate in front of the builders like I did in 2005 and 6, saying, you guys get the heck out of here, sell all your land. Oh, they're going, we're having the time of our life. What are you talking about? And then 2007, we're in big trouble. This time they didn't do that. They normally a peak of like 150, 160 homes. We're at 60,000. You're going to have a bunch of auctions off of 60,000 homes? No. And what happens when you have auctions is that the people that just put 20% down over the last year just lose their down payment because the houses go up, and all of a sudden now you have a lot of potential people going to lose their home because they have no equity, and they're also not real happy. So you go, So trustee sales is the culprit, and so we're like at rock bottom numbers. So be really careful when somebody says, "Oh, trustee sales are up, 1,000%. Oh my God, they went from 2 to 200 or something, It has to represent a big piece. Now, if sales volume goes down by half, instead of 400,000 sales, you get 200, you got to think about the correlation of trustee sales mean more, right? So 50,000 trustee sales, which isn't a lot on this chart, could be 25% of the market. Okay, we know that's survivable. We've had that before. If you had 100,000, now it becomes half of the market. If it became 150,000 against 200,000 sales, we're in trouble. Now, you think the lenders want to repeat the mistake they did last time? There's no way. So this is not going to happen with this inventory. So your median price just got killed when the REOs came into play big time, and I don't think the lenders want to do that. Affordability is another chart that tells you that we're done. Now, what's really important, though, is how we got there this time was unique. In 2005, we hit the affordability number. That was the end of the cycle, basically. So we hit 17, and then we didn't stop at 17, which is a normal stopping point. We went down to 15 and then to 12. In a 3-year period, we were really maxed out in affordability, and we did the most sales ever because of the mood. Was yay. So we buried 1.5 million buyers into adjustable loans that they lied to basically to get in, and then the price went down. That's why you had the debacle that we had. Think about how long we were at. We got to 16% affordability this time, but if you looked at the chart for car, it was 24% in the fourth quarter, and then it was 16% the first quarter. We had a 3-month period this time that affordability went down to a danger level, not 3 years. So we buried almost nobody. That's very significant going forward. So it's really going to be fun to watch this play out because the other thing that happened, how have rents done in California? Like a lot? I know you have laws against that, but in Florida we don't. So this is typically, these numbers are attached to a couple of case studies we just played with, and this was when the interest rates were, I think, 5.5. I'm looking carefully. 5.7. Okay, this is a 400 grand house. Thinking, okay, is somebody going to purchase this house as opposed to rent it? And so the math works out that if you get a PITI payment of $2,457 and your principal pay down $337 a month, your net's $2,120, but you'd have to pay almost $2,400 for rent. So, I like a practical thought process and think, okay, if I was a buyer in this market, could I be a buyer instead of a renter? Would I make that decision? Because I don't want to throw away $2,400. We can't be spoiled about what was. So everybody that's dealing with What is, as a buyer, would you be a buyer if your rent was more than your payment? You could see a lot of people would still make that decision. And the same is true with a more expensive home. So this is Florida rent. That home rents for almost $4,000, and your payment's $4,500, and you get $611 a month in pay down. So it's virtually a wash. I don't know about you, but it's important for me to own my own home. I know that. When I wrote the California crash report, my house in Riverside on Piedmont was worth about $1.2 million, which was a nutty number. And I really thought about selling it and becoming a renter. And I called somebody that had a rental, and I said, I'm not your typical renter. I'll pay a year in advance. And he said, oh, that sounds great. He said, let me ask you a question. Do you have any pets? And there was that moment of pause, and I just realized I don't want anyone to ever get to ask me that question ever in my whole life. And I sold that home years later for $550 and could care less. Because I got to call what went on in that little box. That's how important home ownership is to me. So I would be one of those people that would make that decision. I mean, even if it wasn't a math decision that broke even, I still would want to own my home. And I think that's still embedded in us. So it'll be very interesting to see, because the math says this is going to be really bad, but I have a feeling that it'll be prevented by there's so little inventory for sale because of what just happened. We have all these interest rates that are really cool in place. We have the only large group of sellers that are motivated would have to come from I just got unemployed. Not that I just lost my home to foreclosure. And then there's a choice that you could rent that home for a positive cash flow or, sell it and move. So you'll have some sales going on, but I think sales are going to be way down. And it's one thing that's not very good right now is, the mood isn't good, so you're going to have a lot less people want homes, but it's going to be met by a lot less supply.